The September 2021 quarter revenues of construction companies excluding Dilip Buildcon grew at a robust 46% on a year-on-year basis. On a sequential basis also, the revenues grew by 10%. Stronger year-on-year growth can be partly attributed to the low base of Q2 FY21. In the September 2020 quarter, project execution was affected because of COVID-related restrictions and labor migration issues. However, project execution gained momentum in Q2 FY22 with a steep drop in COVID-19 infections as well as labor availability. Most construction companies have stated that labor availability has reached the pre-COVID levels in the quarter gone by, and supply chain issues have also been sorted out. Our high conviction ideas by KNR Constructions, PNC Infratech, NCC and Edgy Infra and Engineering posted similar robust growth compared to the industry at 47% growth in the September 2021 quarter. Toll collections were also robust as traffic movement was impacted in the September 2020 quarter owing to the second wave of COVID-19. As COVID-19 cases dipped, traffic movement picked up significantly. IRB Infrastructure, one of the largest toll players, saw average daily collections rising 27% year-on-year to 4.8 crore rupees in Q2 FY22. Prices of key raw materials like steel, cement, diesel, and bitumen have increased sharply compared to the September 2020 quarter. While construction companies have a pass-through clause for most contracts, it is not possible to implement it in the short term. Raw material costs were up about 400 basis points on a year-on-year basis. The benefits on account of operating leverage due to better execution helped offset the impact of higher raw material prices to an extent. While the margins of construction companies excluding Dilip Buildcon dipped, net profit margins improved by about 100 basis points. A portion of interest and depreciation expenses were on a much higher top line, which enabled better net margins. Interest cost as a percentage of sales for the entire universe stood at 9.1% compared to 12.7% in the September 2020 quarter, driven largely by the strong top-line growth. For our conviction stocks, interest expenses were 4.8% compared to 7.2% in Q2 FY21. Infrastructure remains the government's key focus area given its importance in economic growth, job creation, and support to allied industries such as steel and cement. The government plans to spend 111 lakh crore rupees over the next 5 years under the National Infrastructure Pipeline, with roads, irrigation, railways as well as affordable housing being the key growth areas. Further, the government recently introduced the PM Gati Shakti program, which would bring all the ministries concerned on one platform, where they will have real-time data of projects under execution as well as new projects. This would ensure better planning and coordination among various departments, enabling smooth project execution and avoiding delays. Also, the government is considering measures such as transfer of land, compensations directly to the beneficiary account rather than routing it through the district-level machinery. This would ensure faster commencement of projects. The competitive intensity is expected to reduce as government incentives for new construction companies for project bidding, such as lowering of qualification criteria, net worth requirement, and no performance guarantee requirement, expire in December 2021. This would benefit incumbent players. Execution is likely to be marginally affected in Q3 FY22 thanks to extended rains in October as well as the National Green Tribunal ban on construction activities in the National Capital Region, which was implemented in the last week of November 2021. However, the loss in execution can be made up in the latter part of the fiscal. Given the strong momentum in H1 FY22, most companies have maintained a revenue guidance for FY22. Construction companies have a strong order book of 4.5x revenues, which give healthy growth visibility. Most companies have guided for healthy order inflows given the government focus on infrastructure. However, rising interest rates can affect the profitability of the infrastructure companies as well as their new order-taking capabilities, especially high-leveraged companies. In this context, we advise investors to stick to our high conviction ideas like KNR Constructions, PNC Infratech, NCC, and Edgy Infra and Engineering, given their strong execution record and healthy balance sheet with debt to equity ratio close to 1x, would enable them to take full advantage of the huge spend in infrastructure. With the benefits of operating leverage owing to the robust top-line growth, these companies can offset the higher finance cost from the rising interest rate scenario. Investors can use the market weakness to add high conviction to stocks in the portfolio.